Welcome to another awesome video, and today we're going to take a look at 7 beginner investing mistakes that most people make. Stay tuned. All right, so if you want to invest, you want to put a little bit of money aside, try to make a little more money from your money. We're going to talk a little bit about some of these mistakes that most people make. And I'm going to give you some tips and insight as well as you look to put your money into certain places and areas. Of course, for everybody, it's going to be a little bit different just because your investing risk tolerance might be different from other people's. Your capital size might be different. So you have to take it with a grain of salt and just take a look at your own personal situation and see what makes sense for you. So let's start out with some mistakes. Mistake number 1, and that is delaying investing. So money in the bank, it loses value over time just simply due to inflation. Also, if you start investing early in your life, you can take advantage of the compounding effect, which could make you a millionaire by the time you retire, depending on market conditions. So here's some insight from NerdWallet. If you take a look at compound interest calculator and you put away $50,000 and you contribute $1,000 a month over a span of 25 years with an average return of about 8%, you could see that you could reach that $1.1 million dollar mark. So again, here's your balance of 1.2 million or so. But again, this of course assumes that you don't take money out. It assumes you're compounding. It assumes your rate of return is about 8%. But a lot of people, they just start investing really late. I've talked to people in their 60s. They say, hey, I want to start investing now. And that usually becomes a much deeper problem after the fact. So be very careful if you wait too long. So start early, start a little bit. Even if you're slow growth, you might only have a couple $1,000. Just starts the snowball effect and gets it rolling. All right, let's take a look at mistake number 2, and that is day trading and trying to time the market. So trying to find the perfect time to buy or sell stocks is, it's a way to make money fast. That's what people are looking for. But when it comes to day trading, it's a lot more risky if you don't know what you're doing. So there's no perfect in the market. A lot of the day trading they watch the charts, they're looking at things very closely. And this is kind of what we do in one of the other channels that I have. If you look at my Traders Fly website or my Rise to Learn website, there's also a lot of content there about trading, investing in options and that kind of thing. And that's where we take a look at all these different charts and we're looking at more timing the markets more appropriately. But for the average person, this just does not make sense. It's not something that you're looking to do because there's just much more of a learning curve to it. So instead, if you're trying to time the market with day trading, trying to make some passive income with day trading, or trying to make some money on the side with day trading, it's probably not going to work out for the majority of people. It's more of a business type of thing, or you're looking for day trading. It's something you have to be doing very actively and very consistently. So I would say stay away from that. Let's look at number 3, and that is chasing trends. And taking a long-term investing approach is usually better for beginners and most people in general, rather than chasing a short-term trend based on hype or fear of missing out. Short-term trends could also mean things like cryptocurrencies. If you don't know what you're doing, things like Bitcoin, Ethereum, many out there. It could be a huge problem for you if you're just trying to chase the markets. So what is chasing? It's basically as the stocks are going up or any kind of trend that's happening, whether it's in real estate, whether it's in cryptos, you're going in after the fact where, hey, I want to catch up and I want to make some money on that as well. So here, if we look into some of these stocks, I'm going to show you like a Tesla. Here is, let's go in with the chart just to show you. And the way these charts work is you've got price on the right side, you've got the time frame on the bottom. So if you're trying to chase this stock and this stock's already been fairly explosive. If you just look at this chart, it's very explosive. And if you're trying to get it way up here, that could be a recipe for disaster. So be careful chasing these things. Just if you do that, you got to understand what you're doing, how much risk you're putting in. Even things like NVIDIA here that we've been looking at recently in the Traders Fly channel. Then you can see this one's been really accelerated a lot due to the cryptocurrency and stuff. But this is what we talk about here in the Traders Fly area, where there's tons of other videos if you're interested in that kind of stuff for trading and more investing. All right, another big issue and huge mistake that people get into is not diversifying. Diversifying your investments is important because it helps you manage your risk and reduces the chance of losing all your capital if one of your investment goes wrong. Have you ever heard of Enron? went bust. Have you heard of things like GM? A lot of companies, they're usually fine on the stock market if you get good, solid companies that pay you dividends, but there are some that still have some trouble. So diversifying, splitting your money into different baskets like an Apple, a Microsoft, a PayPal, a Facebook, a Pinterest, a Tesla, a McDonald's, that can spread out your nest egg. And really, when you're looking at things, if we've got something like, hey, even if PayPal goes down and we've got a huge issue, at least a lot of our other capital is still kind of safe. And that's the point of diversifying, is that you're just looking to split things up. Because even looking at the current chart right now, if you check out PayPal, you can see how this one's been kind of rolling over lately. So we've had some trouble here, and that's why splitting your capital into different sections is a wise thing to do. And even beyond the stock market, whether it's in real estate, gold, coin, silver, doesn't really matter. Just not everything in one basket, right? That just makes more sense. All right, mistake number 5, following advice from social media. So make sure you do your own research before following investment advice from social media gurus. So here you could see pump and dump schemes are now openly orchestrated on social media. I've even talked about this in some of my videos in the past. Here, how to pump and dump penny stocks with a YouTube channel. So if you have a YouTube channel, you could pump and dump penny stocks. So watch some of these videos. This is on that other channel that I mentioned. But basically what people do on YouTube that say, hey, these are the current stocks I'm buying for the month. So they might already be in those stocks. And what they do is they go ahead and then say, hey, I'm going to buy more of these, or I'm already in it, or, and then they're hoping with a large following, more people get in it. And then what happens is it skyrockets that stock price higher. And as it climbs higher, they're starting to sell out of it. And then another video is released about a week or two later where, hey, I got out of the stock. And then eventually all their followers start dumping it. So it's basically a group buy or a pump and dump scheme through a large YouTube following. So anybody who's recommending things on YouTube, hey, this is what I'm buying, or these are the stocks I recommend, probably not the best bet for these kinds of things. If you're looking at analyst reports, a lot of the analyst reports are usually looking out multiple years in time frame. It could be for the end of the year, it could be for multiple years, but that's usually what they're doing. So it's a longer term buy and hold type of thing. All right, mistake number 6, and that is forgetting about taxes. Many first-time investors are not aware of the tax consequences. So make sure you educate yourself when it comes to taxes so that you can avoid a big surprise. So taxes always come up and can be a huge issue. I've talked to many people on coaching and mentoring that I've done over the years for trading and investing. And I've had one gentleman actually who made about $330,000 or $350,000 or so on his trading account. And there was a large tax surprise bill that came to him towards that next year. And he wasn't happy about it. So just be aware that, hey, taxes will come. And if you're making money or your investments are making money, depending on the tax shelter that you have for your investment account, will depend on the tax consequences or liabilities that you have to pay out for that account or for those earnings. All right, mistake number 7, and that is investing too much money. Can you invest too much money? Yeah, you can. So never invest more money than you can afford to kind of lose. As we talked about, there's some companies like Enron or GM that have had problems. Even AIG has had issues in the past. So it's always better to start small and build your way up as you gain more knowledge and experience. Again, spreading things in different baskets, different types of investments, because you never know when an investment actually does go sour. There's a lot of stuff out there. Just looking at some charts, here is GameStop. You can see where it skyrockets and those things could pan out. But then again, you have others where, like, take a look, here's Groupon that's, had some issues, and you can see from about that $500 range, because it kept splitting. That's about the opening value. You can see it keeps falling. So these things could have some issues. There's also GoPro, where I traded it quite heavily many years ago. And in 2014, it looked like it was skyrocketing, but then since then, it's just been plummeting down and had quite a bit of issues. So now it's back up to about $11 a share, but it used to be at about 100. So you can see there's a lot of issues that could come with some of these stocks that, hey, splitting things up is just a better way, starting small, growing that account, and that's just usually better off for a lot of people. Anyways, thanks for joining. I hope you enjoyed these mistakes, got some insight out of it. Maybe it'll help keep you away from making some of these same issues, errors, or problems in your investment account. And if you enjoyed these videos, feel free to check out some of the other ones that I have, or check out the website at MyLittleNestEgg.com. I'll see you in the next video.